and welcome to Who Moved the Market? I'm Surabhi Upadhyay. Well, the market has decided to move on the upside today. We're finally seeing some green before we get into that midweek holiday. Well, if there's one development that's really moved the market in the last couple of sessions, it's this unexpected change in taxation with respect to debt mutual funds. So now that the dust has settled, we've pretty much made our peace with it. And the market has also learned to move on and understand that come the 1st of April, debt funds will attract higher taxation. What's the fallout on stocks? Stocks of asset managers, stocks of banks, or even NBFCs, which in the past have relied quite heavily on mutual funds, debt funds, for some of their funding needs. Well, to help us understand this and really boil it down to simple stock level stuff, what can you do or should you do? We've got Krishnan ASV joining in. He's from HDFC Securities, and he has been tracking the sector for a very, very long time. Krishnan, now welcome to our digital show. Okay, so, Krishnan, I think now we've had a couple of days to, first of all, internalize this change that's happening, both with actually mutual funds and even the large ticket insurance policies, right? So the reason we thought it'll be great to have you on is to now try and make sense from an equity investor's point of view and see if this has any medium-term or long-term impact on the financials of some of these entities. So let's start with your broad thoughts on these tax changes that have been announced. Are they really material for the players involved?
At first look, it seemed material, but now as you go through the fine print, our own checks within the system, Surabhi, suggest that there's only about 2 to 3 trillion INR worth of funds that are actually arbitrage sensitive, right? So that's out of a total debt mutual fund pool of over 15 trillion. We have a deposit base of about 180 trillion. So now you start seeing that 2 to 3 trillion in absolute levels is a fairly large number. But when you start looking at it in the context of the overall financial system, it then starts becoming less and less meaningful. And this, we believe, is, as I said, arbitrage sensitive. To that extent, once the tax incidence comes along and once tax kicks in from the 1st of April, this is probably the pool that will be most vulnerable, right? And to that extent, when you put this in context of the overall financial system, we believe this is not a very large needle mover across, whether it's for AMCs, banks, or NBFCs.
Okay, so that's an important takeaway, that now that, as things have settled down and, you've done more numbers, it seems that it's not going to have a very big material change in the way the business is looking. Which brings me to my next question. And Krishnan, I was pouring through the notes. So HDFC Securities has put out a note, and they have a coverage on a couple of these asset manager stocks, and they actually have either a buy rating or an add rating on a lot of these AMC names. So Krishnan, that brings me to my question. What's the rationale? Because mutual fund stocks really have been struggling as well over the past, several months now. They've not been the biggest wealth creators, nor has the market for that matter. But if I look at, let's say, a UTI AMC where you have a buy, what's the thought process behind it?
Right. So both external and internal challenges to the AMC industry. Number one, we are in an increasing interest rate environment. We have been that way for the past year. So most of the alternatives to the fixed deposit automatically start taking a little bit of a backseat, right? Because their hurdle rate keeps going up. And now with the tax incidents coming in, that hurdle rate moves up a little bit further. Having said that, UTI AM has been one of our top picks within the AMC industry, largely because their challenges are more internal, right? Number one, on the AMC industry itself, the industry becomes less and less attractive because there's very high competitive intensity. There is very little, bargaining power with AMCs. Plus, there is regulatory headwind on the sector as well in terms of expense ratios, etc. Having said that, we believe the stocks probably went into an correction overdrive. And so there is value. There's value definitely in some of these names. We are relatively more bullish on UTI AM because They have more internal challenges around managing their efficiency ratios, and that we believe has a few low-hanging fruits.
Okay, so you like UTI AMC. For the benefit of our viewers, I'm just going to repeat the ratings on some of the other asset management stocks as well. On UTI AMC, there's a buy with a target of 950. On Aditya Birla Sun Life Asset Management Company, again, there's a buy with a target price of 525 and an ad on Motilal Oswal as well as Nippon Life AMC. So we've discussed the mutual funds, Krishnan. Now let's come to insurance, because the headlines in the last 1 week were all with mutual funds. And before that, I mean, February 1st onwards, it was all about life insurers, right? And how these premium, high ticket, high value, policies, how they will be no longer tax efficient. So again, now having gone through the whole process and, looking at life beyond, what's in store? Because there's been a serious amount of value destruction on insurance stocks. Do you think there's any reason why people can look at some bottom fishing here?
So yeah, I think the budget wasn't very kind to the life insurance industry. So and I think that's reflected in the kind of price correction that these listed life insurance companies have seen. Also, as I said in my initial remarks, Surabhi, I think in an increasing interest rate environment, plus where we are in the interest rate cycle, alternatives, start taking a little bit of a backseat. If you're getting a seven quarter return on a fixed deposit today, the hurdle rate for a lot of these alternative instruments starts going up fairly meaningfully, right? And so it's very difficult to keep outperforming on that, right? And so to that extent, as I said again, I think most of these alternatives got beaten down a little more than what was warranted. To that extent, we have a constructive view on both the life insurance sector as well as the AMC sector. On life insurance, SBI Life is our top pick.
Okay, so that's perhaps a thought that investors can look at. SBI Life is your top idea from the insurance space. That brings me to the million trillion, no, I think, as you said, $2 trillion question, right? Whether mutual funds loss can really be banks' gain. And even if it is their gain, I'm talking about money moving away from debt funds and that money, coming and parking itself in bank deposits. Even if that happens, then is it material change for bank stocks? And bank stocks have a lot of other triggers, from the RBI policy to credit growth, etc. But how would you look at the impact on banks here?
Right. So just directly reading across from what happens to debt mutual funds and what that means for banks and FDs, I think not all of that money can move into a fixed deposit. So if you imagine, if you are a AAA rated corporate and you're managing a treasury, you can't suddenly shift all of that money into fixed deposits, right? So we believe retail money might shift, but the HNI money and the corporate money, a lot of that is fairly sticky with the debt mutual funds, because even beyond tax, there is a very valid value proposition that debt mutual funds offer, right? Which FDs cannot match. So to that extent, I think we should take it with a pinch of salt. We shouldn't get overexcited about all of that money moving in from debt mutual funds into bank fixed deposits. Having said that, Surabhi, I think we are in seasonally I think the busiest part of the quarter, right? The last week of March is usually busy, so there's fair amount of balance sheet management that happens. But I suppose a lot of that will begin to cool off once April begins. Seasonally, it is one of the leanest quarters for loan growth. So I expect that liquidity will become just a trifle more comfortable for the entire system come April second week onwards. To that extent, I think so. So number one, not all of that money will move from debt mutual fund, tax or no tax, does not matter. Not all of that money can move into bank FD. So but then given where we are in terms of scramble for deposits, even a mild positive is a positive at first, right? So banks will benefit, but at the margin, it may not move the needle very significantly. What will happen though is, because there is a sunset clause now in terms of grandfathering for debt mutual funds, and that ends on 31st of March. And what we understand is, since last weekend, there has been a very strong flow of funds into these debt mutual funds, knowing that there is a sunset on 31st March. And so there is going to be a large pool of this capital that comes in, which is sticky more than 3 years, which is coming in purely for tax benefits. And so it's going to be sticky more than 3 years. That's going to chase a very small pool of high grade issuers. Right? So come April to September, not just NBFCs and housing finance companies, but also a lot of AAA rated other corporates could actually see an easing of rates because there is a large pool of capital suddenly chasing, you know, a fairly short supply of paper coming in.
Yeah, I completely get that. The beauty of my job, Krishnan, is that I get to see it from both sides. Just yesterday, I was doing a show in terms of what individuals can do. What kind of debt funds should they park their money in? And the analyst there said exactly what you said. Go in for, top-notch, either, government securities, G-Secs, or top-notch AAA rated, bond funds for that 3-year view. So as you're saying, that's where the money is really moving. Okay, so, help us bring this all down. There's so many moving parts. Like you said, the year is ending. Plus, there's a whole lot of debate going on whether the interest rate cycle itself is peaking, maybe one more or not. Then there is uncertainty, on the macros, on inflation, on monsoon. Given all of this and the fact that the market is offering an opportunity because stock prices aren't running away anywhere, if someone wants to take a call on their medium or long-term portfolio, an investment call, what would be the 2 or 3 top banking and finance picks that you would advise from HDFC Securities?
So at this stage of the interest rate cycle, very clearly, we have been advocating staying with large, durable franchises, banking franchises with fairly strong deposit, modes. And so our pecking order is clearly ICICI Bank at the very top, State Bank of India. So those two would be our top 2 banking picks. And as I said, this could be a very, very convenient environment for NBFCs, amongst which we like Chola and Sundaram.
Okay, all right, Krishnan. So thank you. You're leaving us with some ideas as well. Probably do some more homework around that and hopefully get you back on once things become a little easier and once we're in the new financial year and the new quarter kicks in. Thanks very much for joining in and explaining some of the nuances to us.
Thank you very much. Thank you.
All right, there you have it. Those are views from HDFC Securities. Hopefully that'll be of good use as you are looking at the banking and financial side of your portfolio. We take your leave on this edition of Who Moved the Market. See you again, same time, same place on Friday.